When looking at Indegene, you have to weigh a specific trade-off. You get exposure to high-margin artificial intelligence in the pharmaceutical space, but you also have to absorb the systemic risks attached to global healthcare IT budgets. You need to decide exactly what role this stock plays in your portfolio. Are you treating it as a volatile, fast-moving AI momentum play, or are you buying it as a stable piece of healthcare infrastructure? The company doesn't actually manufacture a single physical drug. Instead, they embed themselves directly into the clinical and commercial software stacks of the top 20 biopharma giants on the planet. This quadrant chart maps out the IT landscape. Unlike traditional, diversified service companies like TCS or Infosys down here in the lower left, Indegene sits far up in the top right corner. They are hyper-specialized. Because they bypass generic IT diversification, your portfolio takes the full impact of the specialized healthcare sector goes through a cyclical downturn. That specialization creates a regulatory moat. Their strict adherence to FDA compliance and deep operational knowledge effectively block generic tech companies from competing for those same enterprise contracts. Pharmaceutical companies are currently moving away from traditional field sales teams, shifting their budgets toward automated, data-driven omnichannel marketing. Indegene is driving this shift with their own internal artificial intelligence tools, like NextGen OM and Copilot. These platforms directly automate the generation of medical content and conduct complex safety reviews. But this comes with strict geographic dependence. The vast majority of their revenue is drawn directly from North American and European healthcare budgets. This high barrier focus delivers stable operational margins. However, it also completely links the stock's future to U.S. health policy decisions and potential global pharma spending cuts. We need to strip away the AI buzzwords and look at the actual financials to see if this narrative is translating into real bottom-line profitability. This bar chart shows a steady 18 to 20% revenue CAGR. Expanding on this, they maintain an 18%. Looking past the long-term fundamentals, we need to examine the current technical entry zones to evaluate the immediate risk-to-reward ratio. This candlestick chart shows the stock exiting post-listing volatility, entering a sideways consolidation base, and forming a classic flag pattern. We can identify structural support floors where institutional buyers absorb selling pressure during pullbacks, while overhead resistance caps the upside. The relative strength index is currently sitting in neutral territory. This leaves room for upward momentum once that upper resistance level is broken. Buying during this consolidation phase limits your downside risk. The trade-off is that your capital might sit range-bound until a clear macro catalyst forces a true breakout. To value this potential, we look at probability-weighted outcomes based on how the market typically prices high-growth life sciences tech. These targets reflect the 18% growth trajectory and the margin efficiency we've already observed. This bell curve models our projections. The center 50% probability base case sits at INR 710. The 30% bull case assumes accelerated tech budgets, moving the target toward INR 850. Conversely, a 20% bear case reflects budget cuts, retreating to INR 490. With an 80% combined probability heavily skewed toward the base and bull outcomes, the mathematical risk-to-reward ratio is favorable, provided the broader U.S. macro environment holds steady. This flowchart brings us to the scenario match. What is your primary portfolio objective? If you're a fundamental compounder prioritizing digital healthcare tailwinds, your path is long-term growth, accumulating shares on market dips. The catch here is patience. You have to be willing to lock up your capital and ignore short-term technical volatility to realize that 50% base case return. If you are a risk-conscious allocator prioritizing capital protection against those 20% probability macro shocks, your strategy requires a strict stop-loss positioned just under INR 490. While a strict stop-loss shields you from U.S. regulatory shocks, you run the risk of getting stopped out prematurely by normal, everyday market noise. Ultimately, Indegene's overall utility in your investment portfolio depends entirely on your personal capacity to tolerate single-sector macro concentration. Indegene is a precision instrument. It is not a broad market tech safety net. If you are looking for generalized tech diversification, you should look elsewhere. Their deep FDA-compliant moat, zero debt balance sheet, and steady 18% return on equity firmly validate their high fundamental quality. You need to evaluate your own risk matrix and position sizing strategy before deploying capital into this current consolidation zone. For the disciplined investor willing to trade diversification for targeted specialization, Indegene offers a structurally sound, AI-driven vehicle for long-term wealth creation.